Welcome back to the Trading Psychology series. Great to have you with us for episode 4.
Glad to be back.
We've covered quite a bit so far in this series, right? Building that discipline, handling those setbacks, and really getting into the trader's mindset.
Absolutely. That psychology is key.
But today, we're tackling something that's often overlooked, even though it's so crucial for that consistent profitability in the markets. Setting realistic goals and expectations.
Yeah, I think that's spot on.
You might be thinking, hold on, isn't the goal always just to make as much money as we can, as quickly as possible?
Right. Maximize those profits. Isn't that the whole point?
Well, it's not quite as simple as that. Let's explore why.
I'm all ears. I think a lot of new traders especially get caught up in that get-rich-quick mentality.
Yeah, those flashy headlines, the social media posts showing those overnight success stories. It's alluring, but the reality of trading, it's a lot more nuanced.
Exactly. Those unrealistic expectations can set traders up for a wild ride, and not in a good way.
A roller coaster, you mean?
Exactly. A psychological roller coaster. And often it leads to just disappointment, frustration, and a lot of traders just give up entirely.
They throw in the towel. It's like trying to build a house on sand, right?
Right.
No foundation. Those expectations are flimsy. The whole thing collapses.
Perfect analogy.
I remember when I first started trading, oh man, I had these wild dreams of turning a small account into a fortune, and like within a few months.
No, I've been there. We all been there.
I was chasing every hot tip I could find, jumping in and out of trades constantly, tweaking my strategies every other minute. It was exhausting and honestly, disastrous. Just disastrous.
It's that initial excitement, isn't it? The allure of those quick profits. It can really cloud our judgment.
Totally. But here's the thing, and I think we need to keep reminding ourselves of this. Trading is a skill.
Absolutely.
Just like playing an instrument or mastering a sport. It takes time, it takes dedication, and you have to embrace the process of learning and improving. Constantly.
And it's ongoing, always improving. But those unrealistic goals, they just create this intense pressure for instant results. And then impulsive decisions, overtrading, and ultimately more losses.
Yeah, you end up shooting yourself in the foot. It's like trying to run a marathon with zero training.
Oof, yeah.
You start strong, adrenaline's pumping, but you're going to crash and burn. Trading, it needs a different kind of stamina. Mental resilience. And that's built through patience, discipline, and mastering those fundamentals.
Couldn't agree more.
So where do realistic goals fit into all of this?
Realistic goals, they're your roadmap. They guide your trading journey, help you track that progress, and keep you going even when the market throws you those curveballs.
Keeps you motivated.
Exactly. It's about shifting that focus away from those quick hits of euphoria and onto that consistent execution of your trading plan, win or lose.
So how do we actually set those realistic goals in trading? What are some steps traders can take to create that framework that will support them, for the long haul?
Well, one framework that's helped me a lot is the concept of SMART goals.
SMART goals.
Yeah. It stands for specific, measurable, achievable, relevant, and time-bound. Let's break down each of those and see how they apply to trading.
Okay, sounds good. Let's start with specific. What does it mean to set a specific goal in trading?
It has to be laser-focused. Saying, I want to be profitable just isn't enough.
Too vague.
Exactly. You have to define what profitability means to you. Concrete terms. So instead of aiming to just make money, pinpoint exactly what you want to improve or achieve in your trading.
Okay, so get granular.
Exactly. For example, a specific goal could be, I will apply my risk management rules consistently on every single trade.
Okay, so move away from those vague aspirations and create goals that are, like you said, clearly defined and actionable. What about measurable? How do we ensure our trading goals are quantifiable, that we can track them?
It's all about tracking progress and holding yourself accountable. It's not enough to glance at your overall account balance and just, hope for the best. You need metrics, concrete metrics.
To gauge your performance.
Right. Are you tracking your win rate, your average profit per trade, that maximum drawdown? These are quantifiable elements that give you a much clearer picture
of your strengths and weaknesses.
Yeah. It's not just about the profit or loss, but understanding the nuances of how you're performing.
I see. So by tracking these specific metrics, we can see where we're doing well and where we need to improve. That information can then inform our future trading decisions, right?
Exactly. Gaining those insights into your habits, those patterns, that's what can really help you refine your approach and make better decisions. Now, let's move on to achievable. This is where we have to be honest, brutally honest with ourselves.
Separating those pipe dreams from the goals that are actually within reach.
Exactly. Setting a goal to turn $1,000 into $1 million in a year, that's just not achievable for most traders, and it's probably going to lead to frustration, risky behavior.
Yeah, desperation.
Exactly. Instead, focus on gradual account growth. Aim for a consistent, say, 5% return every month, or maybe mastering one specific trading strategy. Those goals should challenge you, for sure, but not set you up for failure.
Okay, so ambitious but attainable. Those stepping stones that build confidence propel us forward. What about relevant? How do we make sure our trading goals align with our style, our individual trading style and our overall goals?
It has to resonate with your personal trading style, your risk tolerance. It's finding what works for you, not chasing someone else's strategy or trying to fit yourself into a box that just doesn't work.
Right, find your own groove.
Exactly. If you thrive on that fast-paced action, maybe day trading is your thing. But if you prefer a more laid-back approach, maybe swing trading or long-term investing would be a better fit. Understanding your strengths, your weaknesses, your preferences, that's key.
It's about creating a trading plan that's a reflection of our own personalities and our aspirations, not forcing ourselves into something that doesn't fit.
Exactly. And then we have time-bound deadlines. They're crucial.
So important. Why? Why are deadlines so important for our trading goals?
They create accountability and that sense of urgency. It's easy to get lost in the day-to-day of trading, but having that time frame keeps you focused, keeps you motivated. Without it, goals fade into the background. They lose their power.
Yet they lose their teeth. It's like having a roadmap with clear milestones so we know where we're going and when we need to get there. That structure, that accountability can be so helpful, especially when the market throws those inevitable fluctuations at us and it tests our resolve.
Absolutely. It keeps you on track. It really does. Those deadlines, they keep us moving. Now let's shift gears a bit. Let's talk about measuring success beyond just profits.
Okay, I like that. Beyond profits. Because I think a lot of traders can get fixated on their account balance. Riding that wave of wins and losses, it can be a roller coaster.
It absolutely can be. And focusing solely on profits, it can be really misleading, even detrimental to your growth as a trader in the long run. Interesting. So how do we measure our progress? How do we define success if we're not just looking at those profit numbers?
That's where we look at what I call process-driven metrics. It's evaluating those aspects of your trading that are within your control, the actions, the decisions that ultimately contribute to consistent profitability.
Okay, I'm intrigued. Break down these process-driven metrics. What are we talking about here?
One of the most important is trade execution consistency. It's not about winning or losing every trade. It's about sticking to your plan, those entry and exit criteria you've established based on your strategy.
Okay, so emotionless trading, basically. Just executing the plan with discipline and consistency.
Exactly. Another crucial metric is your risk management discipline. Are you sticking to those predetermined loss limits, those stop-loss orders that protect your capital?
Right, because those losing streaks, they're going to happen.
It will happen. Are you managing those position sizes properly, making sure no single trade can wipe out a huge chunk of your account?
This is where that mental fortitude comes in, right? That ability to walk away when things aren't going your way, even when FOMO is screaming in your ear.
Exactly. It's about that unwavering commitment to protecting your capital, even if it means taking a loss. And then there's emotional control. This is huge.
Oh, yeah. Big one.
Are you making rational, calculated trading decisions based on your analysis, your plan? Or are you being swayed by fear, greed, or what someone else is saying?
Right. This is where all that work on trading psychology comes into play. Recognizing those emotional triggers, having those strategies in place to stay calm, objective, even when the market's pushing your buttons.
Spot on. And another crucial metric, continuous learning. Are you dedicating time each week, each day even, to expanding your knowledge, refining those skills?
Keeping up with that ever-changing market.
Exactly. Staying curious, exploring new ideas, refining your approach as you gain experience. These process-driven metrics, they give you a much more holistic picture of your progress. They help you see where you're excelling, where you need to improve, and ultimately it helps you become a more consistent, profitable trader.
It's about shifting that focus away from those external factors we can't control, like market direction, and putting it on those internal factors, our discipline, our emotional state, our commitment to learning.
You got it. It's recognizing that true success in trading, it's not just about the big wins. It's about applying sound principles, mastering those emotions, and that pursuit of self-improvement. To solidify this, I want to share a story about a trader I knew a few years back. We'll call him Mark.
Okay, I love a good trading story. Lay it on me. What was Mark's journey like?
Mark was obsessed with profits, like many new traders. constantly chasing those big wins, jumping strategies, taking crazy risks, all for those riches. He'd have those moments of euphoria when a trade went his way, but then he'd get crushed by those losses that come with that kind of reckless trading.
Sounds familiar. I've been there. It's an emotional roller coaster, isn't it? Chasing those highs and lows, but ending up exhausted and disillusioned.
It is, and that's what happened to Mark. He had a rough patch, a series of losses. It really shook him.
Oof, yeah. Those can be tough.
But it was his turning point.
So what changed for him? What was his aha moment?
He realized his focus on profits was actually sabotaging his trading. It was this constant pressure to be right on every single trade, led to those impulsive decisions and more losses. So he shifted his focus, started prioritizing those process-driven metrics we talked about.
He took those negative experiences and used them as fuel for growth, turned those setbacks into opportunities to learn and improve.
Exactly. He got serious about mastering his trading plan, following his risk management rules, working on emotional control. He started seeing those losses not as failures, but as feedback, opportunities to refine his approach.
His mindset shifted from outcome-oriented to process-oriented, stopped obsessing about profits, and focused on the things he could control.
Yes, it was gradual, but it paid off. His trading became more consistent, more disciplined. He wasn't hitting those massive wins anymore, but his losses were smaller, more manageable. He was no longer controlled by his emotions. His decisions were logical, strategic, based on that unwavering commitment to his plan.
He found that peace, that stability in his trading. He wasn't chasing those highs and lows, but building a solid foundation.
Exactly. And you know what? By shifting that focus away from profits, his profitability actually improved. No more impulsive, emotion-driven decisions leading to those big losses. He was trading with discipline, patience, and a deep understanding of his own strengths and weaknesses.
Powerful story. It shows how those small actions, when applied consistently, can lead to those big changes.
It's not about overnight success or flashy strategies. It's building those solid foundations, the habits, the mindsets that support that consistent profitability. Now let's talk about another element of setting realistic expectations in trading, balancing consistency and adaptability.
Okay, consistency and adaptability. They sound almost contradictory, but in trading, they're both so important. How do we reconcile those seemingly opposing concepts?
It starts with understanding the difference between your core trading principles and those aspects that need that flexibility, that adaptation. Your core principles, those are the non-negotiables of your trading plan, the rules you stick to no matter what.
The foundation, providing that structure and discipline. What are some examples of these core principles?
Well, your risk management rules are huge. These are the guidelines that protect you from blowing up your account. Things like never risking more than a certain percentage of your capital on one trade, always using those stop-loss orders, and diversifying to spread that risk.
Those safety nets, those guardrails. Especially important when emotions are running high and you're tempted to chase losses or double down.
Exactly. Then you have your entry and exit criteria. The specific conditions that have to be met before you enter or exit a trade. Maybe it's a certain candlestick pattern, a breakout above a resistance level, or a crossover of those moving averages. Whatever it is, those predefined criteria, they help you make objective decisions, removing those impulsive, emotion-driven actions that can lead to those costly mistakes.
Having a plan and sticking to it, not second-guessing yourself or chasing every little move.
Exactly. And your routines play a role in consistency, too. Establishing those daily or weekly habits for analyzing markets, reviewing trades, journaling your thoughts and emotions, these can have a big impact on your consistency.
It's about that structure, that discipline in our routine, building those positive habits that support long-term success.
Now, while these core principles provide that foundation for consistent trading, adaptability allows you to respond to those changes in the market.
Okay, so we have that rock-solid foundation of consistency, but we also need to be flexible enough to adapt to market shifts and unexpected events that can throw us off course. So how do we find that balance?
Recognize that while your core principles remain constant, certain parts of your plan might need adjustments based on what the market is doing.
Okay, so finding those areas where flexibility is allowed and actually beneficial.
Right. For example, you might have a strategy that works great in trending markets, but struggles when the market is range-bound, bouncing back and forth within a certain range.
Makes sense.
Adaptability means recognizing this and having the flexibility to adjust your approach.
So maybe you switch to a mean reversion strategy when the market's range-bound, or you tighten up those stop-loss orders during periods of high volatility to protect your capital from those bigger price swings.
Exactly. The market's dynamic, constantly evolving, and you have to adjust your sales accordingly. But, and this is crucial, you need clear rules for when and how you'll adapt.
So a systematic approach to adaptation, not just random changes based on gut feeling or something you heard on Twitter.
Right. You need to establish those criteria for when you'll adjust those specific conditions. Then test those changes before you go live. Backtesting, testing on historical data, that's key.
Seeing how it would performed in the past.
Right. And demo trading, testing in a risk-free environment using a demo account, that lets you refine your approach, get comfortable with those adjustments before you put real money at risk.
Like a dress rehearsal.
Exactly. And once you implement those adjustments, you need to review regularly. Make sure they're still effective and aligned with your goals with the current market.
Constant evaluation, constantly refining and adapting our approach.
Precisely. Now, to see this in action, let's look at a trader named Sarah. Her core strategy is trend following. She's got specific entry and exit rules and a strict risk management plan, never risking more than 1% of her account on a single trade.
So she's got that solid foundation.
She does. But she also understands adaptability. When we hit a period of really high volatility, she realized her usual approach wasn't working as well, so she adapted. Shifted her focus to shorter time frames, reduced her position sizes, and even explored options trading to hedge her positions during that volatile period.
So she stayed true to those core principles of risk management and having a defined strategy, but she also had the flexibility to adapt.
Exactly. The key is she didn't abandon her plan. She made strategic adjustments to navigate those choppy waters.
And I'm guessing it paid off.
It did. She weathered the storm. By balancing consistency with adaptability, Sarah stayed disciplined while responding to that changing market, and her performance improved.
Great example. Shows you don't have to be rigid to be successful. Sometimes that flexibility, that ability to adapt, that's what separates those consistent winners.
Absolutely. Trading is a dynamic process. Find that sweet spot between consistency and adaptability, and you've got the two pillars of long-term success.
Okay, so for our listeners who are ready to start implementing this, what can they do? What are some practical steps?
Start by reviewing your trading plan. What parts of your plan require that unwavering consistency? Those non-negotiables, the foundation of your trading.
Risk management, entry and exit criteria. The basics.
Exactly. Then figure out where you have some flexibility. Where could adjustments based on market conditions help your performance?
Right, like adjusting position sizing or changing strategies when the market shifts.
Yes. Once you've done that, start creating those adaptability rules. Define the conditions that would trigger an adjustment and outline how you'll implement and test those changes.
So systematic adaptation.
Exactly. And lastly, create that feedback loop. Monitor your trades, both the consistent ones and those where you've made adaptations. See what's working, what needs refining.
Time for the trading journal.
Absolutely. By tracking your trades, you get those insights into what's driving your success, what's holding you back.
That constant evaluation, that refining and evolving our approach to trading.
You got it. Remember, balancing consistency and adaptability takes practice. Stay disciplined, embrace that flexibility, and keep that trading journal handy. You'll be well on your way to mastering this.
That's fantastic advice. So today we've talked about a lot, from those unrealistic expectations to smart goals and this balance of consistency and adaptability. It's been a journey through some really crucial elements of trading psychology. But before we wrap up, I want to make sure we address one more thing that's key to building resilience for that long-term trading success.
Absolutely. Resilience is crucial. That mental strength to navigate those challenges, those setbacks, those periods of uncertainty that are inevitable in trading.
It's weathering the storms, the losing streaks, the market crashes, and those moments of self-doubt. So how do we cultivate that resilience within ourselves? How do we build that mental toughness to thrive in this chaotic world of trading?
Well, firstly, it's understanding why resilience is so important in trading. The market, it's unpredictable, complex, full of uncertainty, unexpected events, and periods of both incredible wins and crushing losses.
It's not for the faint of heart, that's for sure. You need that mental toughness, that ability to handle those setbacks without losing sight of your goals.
Exactly. Resilience helps you navigate this unpredictable landscape without losing focus on your goals. It allows you to bounce back from losses, adapt to those changing conditions, and stay disciplined when your emotions are tempting you to do otherwise. It's about having that unwavering belief in yourself and your ability to succeed, even when it's tough.
Okay, so let's get practical. How do we build resilience in trading? What are some of the tools and techniques that can help us develop this crucial psychological skill?
One of the most powerful tools is developing a growth mindset, embracing the idea that every experience, win or lose, successful trade, or blown up account is an opportunity to learn and grow.
So it's changing our perspective, seeing those setbacks not as failures, but as valuable lessons.
Precisely. A resilient trader doesn't dwell on past mistakes. They analyze what went wrong, they learn from it, and use those insights to make better decisions in the future.
That constant evolution, that commitment to always being a student of the markets.
Exactly. Another key aspect of resilience is focusing on the process, not just the outcome. Shifting our attention away from those profit numbers and prioritizing the consistent execution of our trading plan.
So detaching ourselves from the emotional roller coaster of those wins and losses and focusing on those actions we can control, like following our strategy, managing our risk, sticking to our plan no matter what.
Exactly. Find satisfaction in those small victories, those moments of discipline and consistency, regardless of the outcome.
Celebrating those moments when we resisted chasing a trade or stuck to our stop loss. Those are the moments that build resilience.
Exactly. Those are the defining moments. Now let's talk about practicing emotional regulation.
Ah, yes, the emotional roller coaster. How do we manage those emotions? How do we prevent them from hijacking our decisions, especially when things are going against us?
It's about having those techniques to stay calm, focused, and objective, even when the market throws those curveballs. Things like meditation and deep breathing can be incredibly helpful in reducing stress and anxiety before and during those trading sessions.
Mindfulness is a game changer, creating that space between our emotions and our actions so we can respond thoughtfully rather than react impulsively to those market fluctuations.
Exactly. Another helpful technique is visualization. Spend time visualizing yourself, executing trades calmly and confidently, sticking to your plan, managing your risk. Imagine yourself navigating those challenging market conditions with grace and composure.
Creating that mental blueprint for success, training our minds.
Forget about taking breaks. If you find yourself getting overwhelmed, frustrated, step away from the screen. Take a walk, listen to music, do anything to clear your head and reset.
Recognizing those moments when we need to step back and recharge, those moments when our emotions are clouding our judgment.
You got it. Now here's another important aspect of building resilience that often gets overlooked. Building a strong support system.
Having that tribe, that community of people who understand the ups and downs of trading.
Exactly. Trading can be isolating, especially when you're struggling. Surround yourself with mentors, peers, or communities that understand what you're going through. Join trading forums, attend webinars, or connect with fellow traders.
Having that safe space to share your experiences, both good and bad.
Exactly. And a mentor can be really valuable, someone who's been there, done that, and can guide you through those tough spots.
Mentorship is so powerful. Having someone share their experience and offer that guidance can be invaluable.
Absolutely. And remember, resilience isn't just about your mental state, it's about your physical well-being too.
The mind-body connection, so important.
A healthy body supports a healthy mind. Make sure you're getting enough sleep, eating well, exercising regularly. These are the foundations.
Even a short walk can do wonders.
It can. It's about building those healthy habits. And don't forget to have activities outside of trading. Find that balance. Pursue those hobbies and relationships that bring you joy.
Trading shouldn't be our whole life. It's about finding that balance, those outlets for stress relief and personal growth.
Exactly. Creating a life that supports your trading, not a life that revolves solely around trading. We've covered a lot when it comes to building resilience, from mindset to prioritizing the process, managing emotions, building a support system, and taking care of yourself physically and mentally. It's a holistic approach.
It's a continuous process, right? Self-awareness, self-care, and constant growth.
Exactly. It's a journey. To wrap up, let's leave our listeners with one key idea, something to hold on to as they build their resilience.
Okay, I love that. What's the takeaway?
Remember, building resilience is a journey, not a destination. It's ongoing. It's self-discovery, growth, adaptation. Start by identifying one area where you struggle with resilience in your trading. Then, pick one strategy we talked about today and address that challenge. Even small steps, when applied consistently, can lead to big improvements.
Love that. So listeners, think about where you could use a little extra resilience in your trading. What's one small action you can take today to build that mental toughness?
And you don't have to do it alone. Reach out to your support system, find a mentor, or join a trading community. We're all in this together.
It's amazing how just shifting your perspective a little, taking those small steps toward building resilience, can make such a big difference in your trading journey. It's not about becoming some kind of superhuman trader, right? It's about those coping mechanisms, the mental tools to get through those rough patches without losing sight of the goal.
Absolutely. Resilience, that's the groundwork for long-term success. It helps you ride those ups and downs, with grace and determination. But there's one more thing we need to talk about. It ties everything together and really gives you that roadmap for sustainable success in the markets.
Okay, I'm all ears. What's this final piece of the puzzle?
It's creating a long-term trading plan, one that integrates your financial goals with your personal and professional life. It's like creating a roadmap that makes sure your trading journey aligns with your overall vision for your life.
I love that. It's not treating trading like it's in a silo, right? It's part of a fulfilling life. It's just one piece of the puzzle.
Exactly. A well-structured, long-term plan gives you direction, clarity of purpose, keeps you focused, even when the markets are going haywire and those emotions start to get the better of you.
It's like having a compass guiding you through the rough seas. Make sure you reach your destination. That roadmap keeps you on course. That vision lights the way, even when things are uncertain.
Perfect analogy. So let's break this down. How do you craft this comprehensive long-term trading plan? What are the pieces we need to consider when we create this roadmap for success?
Okay, ready to roll up my sleeves and get to work on this plan. First step, where do we begin?
Start with defining your vision. Take some time to really envision your ideal trading journey over the next few years. Ask yourself, what do you want to achieve through trading? How do you see it fitting into your life?
Painting the big picture. The dream scenario, the thing that keeps you going when it gets tough.
Exactly. And don't limit yourself to just money. Think about the lifestyle you want to create through trading. Freedom and flexibility to work from anywhere, more time with family, the security to chase a passion project. What does that look like for you?
Connecting those trading aspirations to those deeper values that drive us, aligning our trading goals with our life goals. So trading enhances our lives, not the other way around.
Exactly. For example, maybe your vision is to grow your account to a level where you have financial independence, but you also want the freedom to travel, spend time with family, or maybe work on that creative project you've always dreamed of.
Trading is a tool to create the life we want, not the only thing in our lives. So we have that clear vision, that inspiring picture. What's next?
Next, you set specific financial goals. These are going to be the stepping stones that pave the path toward that vision.
Okay, let's talk about setting those financial goals, the concrete targets.
Yeah.
We already touched on the danger of unrealistic expectations, those super high hopes that often lead to disappointment. So how do we make sure our financial goals are both ambitious and achievable? Challenge us without setting us up to fail.
That's where the SMART framework comes back in. Specific, measurable, achievable, relevant, and time-bound. Remember those.
Of course.
These 5 elements will help you set goals that are motivating and attainable.
Okay, let's break those down in the context of setting financial goals for our trading. First, specific. How do we make sure those goals are clearly defined, that we can take action?
Instead of saying, I want to make a lot of money, get specific. How much do you realistically want to earn from trading? Each month, each quarter, each year. Put a number on it.
Okay, so be precise. And make sure those goals are measurable. Have those metrics in place to track our progress, hold ourselves accountable.
Exactly. And break those bigger goals down into smaller milestones. Makes the journey less overwhelming. Plus, you get to celebrate those wins along the way, which keeps you motivated.
Love that. Breaking it down into those milestones. Okay, so specific and measurable, check. What about achievable? How do we balance pushing ourselves with setting realistic expectations? Goals that are challenging but not impossible.
This is where you have to be honest with yourself. Be realistic about your skills, your risk tolerance, the time you can commit to trading. Don't compare yourself to others or buy into those get-rich-quick promises. Trading takes time, it takes dedication.
Run your own race. Focus on your own progress. Celebrate those personal victories. We're all on our own unique journey.
Exactly. Now, relevant. Make sure your financial goals match your overall vision and your trading style.
Right. If your vision is to be a long-term investor, trying to be a day trading millionaire probably won't get you there. Pick goals that support your bigger aspirations and fit how you like to trade.
Exactly. It's all about synergy, making sure your trading goals and life goals work together. And finally, time-bound. Deadlines. They're super important for these long-term financial goals. Why is that?
The deadlines, they create that urgency, that accountability. They give us something concrete to aim for in the future, a finish line that motivates us.
Exactly. Instead of vaguely saying, I want financial freedom, set a date. Maybe I want to be financially independent by 40. Or I want to replace my current income with trading profits within the next 3 years. Having those deadlines helps you stay on track.
Like setting those milestones, those markers of progress, helps you stay focused on where you're going. So we've covered setting financial goals. What else needs to be in this long-term plan?
We need a personal growth plan, one that supports your trading journey.
The learning never stops. The markets are always changing. To keep up, we need to constantly learn new things, refine our skills, and adapt. So what does a personal growth plan look like for a trader?
Think of it as a roadmap for your continuous education. It outlines how you'll learn new things, develop new skills, and stay ahead of the game in the market.
It's like having a growth mindset. Always wanting to learn more, become a better trader.
Exactly. Maybe you commit to reading a few trading books every year, attend webinars, take online courses, or find a mentor who can teach you from their experience.
Being proactive, seeking out opportunities to grow, it's a lifelong journey.
It is. And don't forget those hands-on experiences. Paper trading, back testing, or even just studying charts to understand market patterns and trends.
It's one thing to learn the theory. It's another to put it into practice. So we've talked about vision, financial goals, and personal growth. What else? What other crucial elements are we missing?
Now we need to think about how your trading plan fits into your lifestyle.
Yes. Making sure our trading fits in with our lives, the things that bring us joy and meaning. How do we ensure that trading enhances our lives, not takes over?
It's about being honest about how much time you can devote to trading, without sacrificing your health, relationships, hobbies, the things that matter.
Finding that sweet spot, where trading fits in, adds value, but doesn't create stress or take over. It's just one piece of a balanced life.
Exactly. And picking a trading style that fits your schedule and your personality is key. If you have a full-time job and a family, trying to be a scalper, spending hours staring at the screen, that's probably not going to work. Too much stress.
Right. Maybe swing trading, where you check the market a couple of times a day, or even long-term investing would be a better fit.
Exactly. It's about finding an approach that lets you participate in the markets without sacrificing the other important parts of your life.
So we have our vision, financial goals, personal growth plan, and we've made sure it all fits with our lifestyle. What's next? What else do we need for this plan?
Risk management. This is the foundation of any good trading plan.
You're right. We've talked about it a lot, but it's super important. Risk management, it's how you protect your capital and build long-term success. Without it, you're not really trading, you're gambling.
Exactly. It's having those rules that protect you from losses, because losses are going to happen. It's how you handle them that makes the difference.
So let's get into it. What does a strong risk management plan look like? What rules should every trader have in place?
First, define your maximum drawdown limit. This is the biggest percentage loss you're willing to take on your account before you step back and reevaluate your strategy.
It's like your safety net. Prevents you from wiping out your account.
Right. It's saying, okay, this isn't working. I need a break. Time to rethink things. Then you have your risk per trade. What percentage of your capital are you willing to risk on one trade?
Makes sense. So even if you have a string of losses, you're not risking everything.
Exactly. And don't forget about stop-loss orders. They're your automated safety net, automatically exiting trades when the market goes against you.
Taking the emotion out of those tough decisions.
A good risk management plan, it's like having a guardian angel watching over your trading. Helps you stay rational even when your emotions are taking over.
It's essential for protecting your money, being consistent, and reaching those long-term goals.
Yeah.
Without it, even the best traders can have huge losses that wipe out their progress.
Absolutely. Now, here's another element that many people forget: planning for adversity.
Right, because those bumps in the road, they're going to happen. Losing streaks, unexpected market crashes, those times when your strategy isn't working and you start to lose confidence. How do we prepare for that?
It's acknowledging that trading has its ups and downs. There will be amazing times, but there will also be times when the market pushes you to your limits.
The tough times are inevitable. It's how you handle them that defines your success.
Exactly. So in your plan, outline how you'll recover from a drawdown, those strategies for getting back on track.
Your plan B. What do you do when things go wrong?
Right. Maybe you reduce your position sizes to lower your risk. Maybe you take a break from trading to clear your head. Maybe you study your trading journal to see where you're making mistakes, or you reach out to a mentor for guidance.
Having those tools ready to go when you need them.
Planning for adversity, it's not about being negative. It's about being prepared, having those strategies to handle those tough times.
Okay, so to recap, we've got defining our vision, those things that inspire us, setting smart financial goals, the concrete targets. We need a personal growth plan, a roadmap for always learning, making sure our trading fits our lifestyle, having a solid risk management plan to protect our capital, and planning for those tough times, those moments of adversity.
Exactly. It's all about having a roadmap that keeps you focused and ensures your actions match your goals.
It's about seeing trading as more than just making money. It's a journey. It's self-discovery, growth, and fulfillment.
Absolutely. It's embracing the challenges, celebrating the wins, and never losing sight of that bigger picture, that vision that drives you.
Well said. So for our listeners who are ready to create their own long-term trading plan, that roadmap for success, what are some things they can do right now to get started?
Start by taking some time to reflect on your vision. Disconnect from the market noise, get away from the charts, and just think, what are your aspirations? What motivates you to trade? What do you want to achieve?
Connecting with your why.
Exactly. Once you have that, write it down, make it real. Then break those big aspirations down into smaller steps, concrete actions.
Those SMART goals.
Yes. And tell someone about your plan. A mentor, a trading buddy, a supportive friend or family member. Talking about your goals helps you stay accountable.
Accountability is so powerful. Having those people who support you and encourage you to keep going.
It is. And remember, your plan is a living thing. It can change. It's a guide, but it's also flexible.
Always review, make adjustments, and embrace that constant learning process.
Exactly. Trading is always changing. But with a good plan and a resilient mindset, you can navigate those changes and create a trading experience that's profitable and fulfilling, one that helps you achieve your dreams.
Well said. Thank you so much for joining us on the Trading Psychology series. This has been an incredible conversation, and I know our listeners will take a lot away from it.
It's been my pleasure. Remember, everyone, trading is a journey. Embrace the challenges, celebrate those wins, and never stop learning.
To all our listeners, you have the power to create your own trading destiny. Embrace the journey, stay resilient, and keep learning. We'll see you in the next episode.